Work. Hello, everybody, and welcome to the first ever episode of Show Me the Money. This is a brand new show. I know you're used to hearing me talk about property investing and property finance and stuff like that, but that's just one tiny little minute part of the investing world. And what I want to try and do over the coming months is get a few specialists in other areas of investments. And I have to say, I'm really excited to bring on my very good friend, Lewis Harding, because Lewis, hello, mate, is a stocks and shares guru, shall we say? Let's proper big you up. But Lewis, thanks ever so much for coming on board, and over the next hour or so, teaching us why we should be still investing in stocks and shares. So, Lewis, welcome very much. That's not even a thing. Welcome to the first ever episode of Show Me the Money.
Thank you, Sam. Yeah, well, thank you for having me. Looking forward to getting into some good conversation on stocks and shares and wherever it goes.
Absolutely. Look, well, before I ask you to introduce yourself, if there is anyone watching and you want to ask Lewis a question with regards to investing in stocks and shares, anything in that kind of world, obviously do chuck those questions into the comments. I can see them. I can say hi to Josh. I can say hi to Amy, the wonderful property tax queen, who's also watching as well. So if anyone's got any questions, chuck them up, and as and when we go through, I'll interlude with asking you a few questions from people watching as well. But Lewis, look, give us a quick overview as to who you are to start with, and we'll kick off because I've got loads of things to ask you.
Right, anyway, so brief introduction about myself. So anyway, I'm Lewis Harding, 24, just done 24 on Sunday, feeling old now.
Don't say that, mate. I'm 37 now.
But yeah, I'm from Yorkshire, East Yorkshire, kind of in between Leeds, Hull and York, about middle area a bit. But anyway, so by trade I'm an accountant. I work as an accountant for pension schemes. So I work from home most of the time now, but I'm basically like the main accountant on various different pension schemes. But anyway, I have a big passion for investing in property, but I'm more known for investing in stocks and shares. That's my bread and butter, essentially. My investing style is like Warren Buffett. Probably it's one of the most famous stock investors ever. One of the richest people in the world. I think he's back in the top 5 now or something. But yeah, essentially I'm a value investor, so I invest like Warren Buffett does, wanting to buy businesses at a fair/cheap price, essentially.
So I think for me, there's a differentiation between investing in individual stocks, but also investing in like index trackers and stuff like that. And I the only reason I know about this is because a company I used to work for actually had an IFA that worked there that was like the biggest Warren Buffett fan known to mankind, and that's how I got introduced to the term index tracker. But for you, do you invest in both, or do you invest in one or the other, and which one do you think from a beginner's perspective is actually the right kind of starter point to choose? Because I would imagine individual stock investing can be quite risky.
Yeah, so to start off with, what I would say is like no financial advice, of course, but
I should have said that.
But yeah, so an index tracker is basically a fund which owns all of the market. So let's say, for example, you've got the FTSE 100, which is the biggest 100 UK companies. You've got the S&P 500, which is the biggest 500 US companies. And then you've got World Index. You've got 2 main ones, FTSE All World and MSCI World Index. So if you own a World Index, for example, you essentially own the full stock market. I think with one of the main world indexes, you own 95% of the world stock market. So you basically all of it, because you can't get to some of the nuts and crannies. So yeah, for beginners or people who don't have the time to put into it, index funds are absolutely fantastic. And like even Warren Buffett says, if you don't know anything, just put into a world index fund, wait 30-40 years, and you'll be very happy, because if it returns 7-8% for 30-40 years, you're going to be laughing.
It's the old compound effect, isn't it?
Yeah, simple as that. Obviously, it's going to go like this, like this. It's not going to be just a straight diagonal. It's going to go up and down, up and down, up and down. But that's the premise of it. Over 30, 40 years, 7-8% return. Happy days. But the way I invest into individual stocks, the difference is there is you are investing into individual businesses. And what I'm doing essentially is I'm analysing the business's financial statements, picking out some key figures, which can determine the quality of the business. And then the second part is I value the business based on its future cash flows. And you get to a certain figure. And basically for me, if the stock price is below that figure, I'm potentially a buyer of that stock. If my valuation is a lot higher, I'm just totally avoid, because valuation is the most important thing, in my opinion, when investing in individual stocks. So yeah, that's a brief overview of indexes, individual stocks. If you don't have much time, if you focus on your business, you've got other passions and stuff, crack on, have an index fund monthly. Happy days. Can't knock anyone for that. But if you want to put a bit of time, you've got a bit of an interest, you can delve into individual stocks.
Yeah. It's quite a timely question, actually, from Amy. I'll bring this up on the screen for you. Which is actually, I guess when we're talking about indexes, it's about kind of using particular platforms. Is there one that you use yourself, or you recommend for this kind of stuff?
Yeah, so I think the main two things I look for in a platform is taxes and charges. So over time, as well as your investments compounding, your costs will compound as well. And that will impact what you have left at the end. So let's say, I can't think of the figures off the top of my head, but there's been studies done that the lower your costs with an index fund, the better. And that's why generally over long periods of time, index funds beat mutual funds or hedge funds, for example, because we can invest into mutual funds. Basically, you've got all sorts of different managers. You've got Fundsmith is a big one, Terry Smith. You've got Lindsell Train. These are all UK ones. But you've got all sorts of different mutual funds. It's basically big investment managers investing your money for you. But studies have been shown that over decades, a lot of them, 98% of them fail to be in the market. So by just doing an index tracker, I think the best one, let me think, it's like 0.04% per year, which is a minute charge to own like the world stock market essentially. So yeah, there's so many different platforms. You've got Vanguard, Invest Engine, what Amy's just said. You've got Moneybox. You've got so many different ones. But the main thing to look for is what is it costing you to own what you own. So that could include ISA fees, what your fund charges are, and your taxes as well, because it's great that you're gonna make all of this, but if you're not investing in a nest egg, then you could lose some of it to tax. So there's all of that to think about as well.
Yeah. Do you know what? It's funny, actually. You talk about this. It's a great question, Amy. So if you do have any follow-ups to that, if you had anything else that you wanted to add, just chuck it in the comments. But this is a good question to ask you on the back of what you just said. Is I don't know. I'm struggling to think of something I've read to do with investing where somebody has specifically said it's a good idea to use an IFA, like a financial advisor, to do that hard work for you, to analyze it, to do this, do that. Because the argument that has, I think, pretty much been across the board with everything I've read on this subject is they haven't got your best interests at heart. They're going to be looking at the best things for themselves. Now, as somebody that is a broker of sorts myself, I know that if the FCA ever found that I was giving advice to my clients on the best mortgages based on how much I paid, I'd be in real trouble.
Yeah.
I would imagine that the same for an IFA, but I can kind of understand the thought process of what people have said. No one's got your back like you have, right?
Yeah, 100%. So I have an opinion on IFAs. I kind of see them as salespeople for investments in some ways. Like, you show they're regulated, they're basically allowed to sit you down and talk you through your own personal circumstances. Like, that's something I cannot do at all. I get in big trouble, of course, unless I did my exams, etc., etc. But a lot of the time, let's say if an IFA will, get a new client and stuff, they will only have a select few funds to choose from, and those fund providers will pay the IFAs to be exclusive to them, if that makes sense. So in my view, it should be all the options on the table. So it's a bit like you, Sam, if you had a couple of you could only go to a couple of lenders because they give you a sweet deal. I don't really think that's a good thing for the
So that
client.
I don't know if I'm just different from other brokers. I'm certain that in the old days it might have been a bit more like this, but I do know from knowing a lot of brokers now from the mortgage perspective that when we take into the differences between the kind of fees that we would get from lenders is so minute sometimes that it's not worth going to one over the other because of that. But I don't really think about it about the fees, the costs, anything like that. I just literally just go for the best thing for the client. But I guess what you're kind of saying is I've got open market access. Are you saying that these kind of people don't necessarily have access to everything? It's more they're tied to a certain, few different companies that they would have access to their investment products. Is that right?
That's basically it, yeah. So they choose to have access to a smaller amount, hence they get put into a smaller amount of funds. Whereas, let's say if you're doing it yourself, you've got everything you can think of, but obviously you're doing it yourself. And as well with an IFA, the fees involved are quite hefty. So over time, that can really impact your pot, because you won't believe how much your fees can compound. It's absolutely bonkers. Yeah, it's really, really bonkers how much your fees do compound and stuff.
I've got a few friends that are actually IFAs, a couple of which if my clients say, can you refer me to somebody to help me out with my pension and stuff like that, I have those people available to me, which is great. But a lot of them talk about they've got their own funds that they use. Is that kind of what we're talking about here? Is that it's not necessarily their fund, that's the one they've got access to.
Yeah, that's basically it. And the way I see it is over long periods of time, these funds, mutual funds, have been proven 98% of them don't beat the world stock market. So the S&P 500, the US index, it makes up like 60% of the world stock market. So I've got the data on this. Over the past 100 odd years, it's returned about 9.9% annualized. So it's been proven that mutual funds can't beat that over decades and decades. There's only
so are people basically betting on the market then that the mutual funds are gonna short term or medium term outstrip the longer term index trackers and stuff like that? Is that why people are going for those? It's more of a short term punt, if you like.
Well, the way I see it is an IFA sits somebody down and sells them, maybe not a pipe dream, but says, "Oh, look, we've done this over the past 5 years." Someone sold, and then when they've got the money with them, when you've got your money invested with an IFA, you can switch to another one, but I'm guessing it's quite a long process to do all of that, and it might be, I can't be bothered, let's just leave it. I think it's more, let's say the clients, for example, don't really know all of this, what I'm saying. Like over long periods of time, mutual funds don't beat the market. And there's studies to show that. So yeah, that's my thoughts on it anyway.
I guess so. From my perspective, and maybe I said to you off air, I like to think that I'm maybe in this. One of the reasons I'm doing this show is because I myself am looking for, I've built up my company, it's expanding, I very much understand the property world, but there's loads of different other ways of investing. And I guess for me as a relative amateur, I've always kind of thought to myself, right, if you don't know, you were talking earlier on about individual stocks, checking, statements and all this kind of stuff. That to me, as soon as you were saying that, I was like, nah, I'm out. That's such hard work.
Clever. That's a clever thing though, because don't have the time for it, don't have the interest in it, not doing it. That's a good thing. That's a good thing. Like
I'm kind of thinking if you want to be, because I was talking to our mutual friend, Mr. Paul McGee, about his trading and stuff that he does in the Forex markets. And I kind of thought to myself, well, it's no matter what the investment, whether it's property, whether it's stocks, whether it's FX, whether it's crypto, anything like that. My belief, and you tell me if you share this, is if you don't get it, do it for the long term. If you want to try and get some short term gains, you've got to learn it like you're a freaking expert. and that's how you can trade and play the game. But otherwise, the game has got to be a long one. It's got to be a just chuck it in and let it go, right?
Yeah, 100%. And like you were saying about our mutual friend Paul, like Forex, I thought about it. Could I do it? But my worst nightmare would be sitting at a screen for like 8-10 hours. I
don't know how he
couldn't
does
do
it. I'm
So.
definitely going to get Paul on. Paul has already agreed to come on and share his views on Forex trading. Because again, this is the thing is, so I mean, Forex is one that we see a lot of. Crypto is one we see a lot of. In terms of people advertising on courses and making millions, and these get rich quick schemes, you don't necessarily see it that much from like the stock side of things anymore. Do you think that's maybe because stocks and shares and that kind of investment has maybe almost got like a bit of an old school mentality now? You've got your cryptocurrencies and your NFTs and this cool stuff now that people maybe don't actually see stocks and shares as the get rich quick or even get rich at all sort of type investment strategy that it used to be.
Yeah, so I think a lot of it has come from crypto and NFTs and a little bit of Forex, a lot of the marketing on Instagram and social media. And the performance of Bitcoin, for example, it's there to be seen. It's done really well over the past few years. And then people see hundreds of percent return, and then they see stocks might return 8-10% a year, and they think, oh no, let's just not bother with that. So that's, I think you're totally right. But the way I see it is the stock market is one of those investments which has been around since like the 1800s. So it's been around for a long time. It's been tested and proven. That's another reason why I'm quite very much interested in it.
But it's funny actually, and I think this is just a mentality thing. You're saying to me then, Bitcoin's gone up by X%, 100%, blah, blah, blah. And we, literally, whenever Bitcoin moves, Twitter goes nuts, and the news starts with people talking about cryptos going up and down. The stock market used to be like that. I mean, it still is to a degree, but you have to go searching for it. What I got from what you just said, and again, I think this is maybe a mindset thing, is I could invest loads of money in cryptocurrencies, and I'm sure I'll have somebody come on at some point soon to discuss about cryptocurrencies and how you can invest in various different ways. But I'm going, that sounds really volatile. What you've just told me is, on average, if I, in a decent index fund or a tracker or something like that, I'm going to get 7 to 8% per year on average forever. That interests me a crap ton more than hundreds of percentages up and down. Because for me, then that is because I'm a great believer in diversity and having a diversified investment strategy. And if someone says to me, right, what's your stock investment strategy? Mine's going to be find something that is pretty much going to sit and do the same thing year on year. I can just chuck a little bit of money in it every month, just keep topping it up, but don't take anything out of it. Just let it compound, and see the exponential growth over many, many years. As you say, if you've got 30 years to sit on, you start it up with £1,000 and you stick another £500 a month into it, that's going to turn into £1 million at some point.
Yeah.
And then suddenly, this is the kicker for me. When you've got £1 million and you're making 7% per annum on that, that's when suddenly you could go, hang on a second, that's like an income, right? Like that's like that's double what the average income of the country is. I could now switch that over, and so instead of it compounding, I can just have it every year. I could have 70 grand.
It's funny you say that, because it's one of my goals. One of my goals is to get £1 million ISA. However long that'll take, that is one of my goals, because eventually I'll come on to what my expected returns are and stuff. But if I could get £1 million ISA, you can put up to 20 grand a year into an ISA. I'm 24, so let's say I've got 20 years. Over the coming years, I'm going to earn more money, invest more, etc. So eventually I'll get a big nest egg like that in an ISA.
Have you actually worked out if you started from, say, like year one, you put 20 grand into your stocks and shares ISA, and it did average at, I don't know, just take the piss and say it was actually just 6% or something. Do you know how long, or do you know roughly how long it would take to compound into £1 million? Have you done that?
I haven't done it could get it up on a one of those calculator things. I can't do the maths in my head. I'm a bit lazy. I do it on Excel nowadays, but
I know I might while you're I don't know if I don't want to like make this too kind of figure related, but I think I've done something similar, because the thing is, there's loads of those compound interest kind of calculators and stuff, as you say. I swear I looked at it, and it was something stupid like 15 years or something. Or not,
it's a lot less than what you'd think.
Yeah, it's just
if you
crazy.
If you start with a bigger figure to start with, the time's a lot less.
Yeah.
And that's why a personal goal of mine is before 30, I want £100,000 invested. Because that will do a lot of the heavy lifting for me later down the line, whether it's 40, 50 or whatever. I'm going to be pretty happy. So, So yeah, like I said, it's just about loading up the ISA when you're younger, and it does a heavy lifting as you get on. But the main, like you just said about the volatility and stuff, the stock market won't necessarily return. It won't be like 7%, 7%. It goes through euphoric periods, and it goes through periods of fear. Like, it does go up and down. It's nothing like crypto going up and down crazy, but the stock market does go up and down naturally. If the stock drops 50%, that's quite normal sometimes. Like it's happened with Netflix this week, or past couple of months. That's the one which has been probably the most recent one, which has gone a bit bananas. But like I said, it's about decades, not years. So let's say over a couple of decades, you're getting that 7-8% return. That's fantastic, really. Because it's the data in the past to back that up. So that's why it interests me, because you can go back to like 1870 and get reliable data on it. And to me, if an asset class is like that, you can go all the way back. Happy days. Like you can with property as well. Like you can go, you've got the data going back. So
yeah, and I think this was it. I was watching, not to sort of labour the point too much in terms of just using crypto as our modern kind of comparison when talking about property, and indeed talking about stocks and shares, but and the stock market. But I was at an event fairly recently where Dee Ludlow was doing a presentation about the comparisons between property and crypto, just as an example here. And he was talking about how when you look at the last 20 years or so, property has obviously risen by quite a dramatic amount. But then when you look at how Bitcoin, for example, has gone in the last 5 years, it outstrips it massively. I didn't put my hand up, and maybe Dee will come on at some stage and talk to me about crypto on this, but I kind of thought, yeah, that's all well and good, but that's 5 years of data versus 20 years of data. And I just feel more comfortable looking at the 20 years of data than I do the 5 years of data. And don't forget, 5 years worth of data, or whenever Bitcoin was first invented, I don't even know. But that relatively short amount of data, yeah, it could be amazing because it's really flown up. But who's to say that trend is going to continue? Whereas, with something like the stock market, as you say, we've got over 100 years of data, much more than 100 years of data to go on. And over that period of time, as you say, the returns have been relatively similar. That suggests to me that is a trend that's just going to carry on and on and on and on and be the same forevermore. So it gives you that, when you are looking at a long-term strategy, it gives you that, that greater comfort that actually your money's in a safe spot.
Yeah, because at the end of the day, when you own an index fund, you are owning 95% of the world's businesses, essentially. Well, listed on the
By the way,
market.
I didn't even know that existed until this line. I thought that all of the trackers were kind of either based on a particular stock market, like the FTSE 100, or they were like a bit of an amalgamation, like an emerging markets type thing. I didn't actually know.
You've got all sorts.
I didn't know you could get one about like the whole world. That's amazing. Like I feel like as soon as I'm getting off this call, I'm like, okay, I need to maybe divert a bit of money into there. Because I use Moneybox mainly because Aaron Knightley, our friend Aaron Knightley, told me to use Moneybox. It's easy just to dump money into it, to be quite honest with you. Which I can't remember. Did I ask you this already? I might have said this off air about which platform you actually use.
Yeah, so the platform I use is Free Trade.
Okay.
It's a UK like investing app platform. The main reason I use that one is because for me, it's the cheapest way I can invest in individual stocks and
Right.
ETFs/funds. If I was going to pick one for index funds, will probably be Vanguard, but Moneybox aren't far behind, and you've got lots of them. You can do your research. Money Save an Expert. You can go on YouTube. What investing platforms are great, and you've got a list of pros and cons for all of them.
I guess it's finding a balance between cost and ease. I think it's like
yeah,
anything, isn't it?
Ease of use is a big one. I'd say
Yeah.
Moneybox is a lot easier to use than Vanguard because
I actually
you've got
don't.
an app,
I
very
forget.
easy.
I forget that my money is going into Moneybox because I have the with Moneybox I've got it set to it just once a week. I've got certain transactions that it will just what's the word, top up. So if I've got a transaction that's like 38 quid, it will, or £38.68, it will top it up to 40 quid. And whatever the difference is, it will just take it out of my bank account automatically at the end of that week. So whatever I'm spending, I'm automatically, but I mean, I've got it set to like a certain amount that comes out every single week, regardless. And weirdly, it's on a Friday. I'm like, why would you take money out of my account on a Friday, man? Come on, I'm going to the pub. But it's got it set up for a Friday. It's probably me who's done it. But then everything else is that I just have this top up feature. And that to me is great because it means instead of me doing like that would be the amount I would be investing, but then I have this little bit extra every single week that just gets piled on. And it's probably an extra 25% without me even thinking about it. And that's just stupid things like anything. I think I've got certain things that are set to, it'll go to the nearest £10. So as I said, if it's £26.80, it will go to £30. And whatever the difference is just goes to Moneybox. And then I've got other things that are set to the nearest pound. So if I go and buy a load of stamps, that's such a shit example, isn't it? Who goes and buys stamps anymore? I go buy stamps for 50p, I will round it up to £1, so 50p will go in. And it's just those little bits, they all add up. And I've only been using it for about 18 months. And I literally didn't even look at it for about 3 or 4 months. And then when I looked at it, I was like, oh, there's actually like, a few hundred quid in there now. It's like, that's just out of nowhere, really. I haven't even really thought about it.
Yeah, well, that's the thing. If you've got a platform you like as well, and it's reasonable for charges and stuff, you invest in a tax efficient account, basically an ISA. Yeah, go for it. There's lots of different platforms. Do some research yourself on it, and YouTube's probably the best place to have a look at the reviews and see if it's up.
Well, they just need to just have a look at your YouTube, mate. That's what everyone needs to
can have a look at my YouTube.
Yeah, if there isn't already, there will be. If you're watching this live, there might not be a link in the description below, but there will be if you're watching this back. So go and click on Lewis's after you finish watching the video. Obviously, go and click on Lewis's YouTube, because you do one thing that I love about your YouTube channel actually, and this is, and I know that we're like part of the same kind of networking group and stuff like that, but I genuinely, of all the people that we are in a group with, your videos are one of the ones I genuinely actually watch.
Oh, wow.
because I find it really fascinating. Because I think also, one thing I'm inherently interested in is business. I love finding out how people run businesses and why businesses do well. And stocks is essentially the world of which business is doing well. And that's why I find it really fascinating. So you do a kind of a regular update on different types of stocks and what's going up and what's going down and why and all that kind of stuff, which is incredibly helpful. I'm going to put you on the spot a little bit. Okay.
Go for it.
So we've had, in the last 24 hours, this is going out, this is live on the 22nd of April, 2022. Last 24, 48 hours, loads in the news about Tesla. You have some Tesla stock, don't you?
I don't know.
You don't? I thought you did. Why did I think that you did? Maybe it's Aaron's got some Tesla stock. I don't know. But obviously that's gone through the roof recently. How could someone have envisaged that happening? Someone that was like, do you know what? Which stocks am I going to be looking to invest in over the next, week, 2 weeks? Oh, I can see that something's happening at Tesla that's probably going to mean that we see the huge spike that we saw, in the last couple of days. Is there something people could actually be looking out for? And if so, how did you miss it, man? Come on.
in terms of like in a short period of time like that, I personally, well, it's probably to do with we probably had some quarterly earnings or something that came out, some quarterly results, and that's why the stock's gone up or down. I think it's gone up if you've had a good earnings or something. But in terms of in the short term, I can't really give you an answer on why. In the short term, stocks go up and down for all sorts of different reasons. Tesla's one of the most popular, it's one of the most traded stocks in the stock market, not just from individuals like us, but big investment funds are all in Tesla as well. So in the short term, it's impossible to know why it goes up and down. But yeah, one thing I would say about Tesla is I personally think it's quite an overvalued stock. It's quite hypey, if that makes sense. Basically,
is that to do with someone like Elon Musk as the face of that company?
There's a lot of reasons. Don't get me wrong. I think it's fantastic business, what they're doing, what they've done for electric vehicles, pushing that on. Because if Tesla weren't there, would VW, Mercedes, being all of them, what would they be now pushing the e-revolution, whatever you want to call it? They've forced everyone's hand to go from petrol, diesel, and come on, they've got to compete with them now. So in that respect, fair play to them. But just because it's a cool company, they're doing good things, it doesn't make it a good investment. At the end of the day, you've got to pay a certain amount for when you're buying a stock, you're buying a very small sliver of a company. Mm-hmm. And in my view, Tesla, at current valuation of 1 trillion, it's a bit pricey, let's just say that.
That's
based
nuts,
on what profits and cash flows it's producing.
Yeah, it's such a young company to be valued at $1 trillion. Sorry, I shouldn't say trillion pounds. That is just for me. That's nuts. I was literally over Christmas reading Elon Musk's biography, which is a really good read, by the way. And just to think that having read and know a relatively reasonable amount of how that company came into being and the risk that was taken by Mr. Musk.
I don't know if you knew this, but a few years ago they were free, like 2 or 3 weeks from bankruptcy. That's how on the edge that company has been until recently. So all sorts of stuff has happened with them.
Yeah, it's crazy. I mean, you'd think that a green company, and everything I read a lot about this kind of stuff, and lots of things seem to be pointing towards, the fact that green technologies in the future are going to be it's just going to be technology. It's not going to be green technology. It's just going to be technology. So something like Tesla, would you put that in the bracket of, okay, you say it's a bit overpriced now, but would you put something like a Tesla stock in the bracket of a stock that is just shove some money in and keep for a long period of time, a little bit like you would with something like an index tracker? I'm sure you've probably got 1 or 2 or maybe even more stocks where you just go, do you know what? I'm happy to dump some cash in that and leave that for 20 years because I know it's going to be great in 20 years time, because it's just such a strong company that there's no way that it can't continue to grow.
Yeah, so if we give Tesla for an example, I wouldn't necessarily do that with Tesla because the valuation of it is so steep that I personally think it could drop 90%. Like no joke, I think it could generally fall 90% to get to a value I'd think, right, okay, this is now an interesting value. I think the difference with like the index fund just plonking money in each month versus the individual stock, with the index fund, you've got that data going into the past, like the S&P 500, 100 odd years, nearly a 10% return annually, obviously up and down. But with an individual company, if it's that overpriced, sometimes it will never get to that price again. And there's a few examples of this actually. So there's a few companies which I don't know if you knew, but in the year 2000, in the 2000s, there was a tech bubble. The stock market was in quite an overvalued territory. Basically, if your company had .com at the end of it, it just went up.
Mm-hmm. It's so stupid when you think about it now, isn't it? That's so ridiculous.
Yeah, there was a company called pets.com, which went public. I think Amazon were a backer at one point. But yeah, anyway, all these tech companies just went really, really high and eventually all just came back crashing down to earth. And 2 companies, there's one called Cisco and one called Intel. So both of these companies at the time were like the Tesla of the 2000s. Cisco, there's actually news articles you can from the
They
Wall
used to
Street
do all like
Journal.
the telecommunications, right?
Yeah, and they're still around.
Yeah, I used to know someone that worked there years ago. Yeah,
yeah, they're a good company, to be fair. Solid company, but they were news articles basically saying, obviously, it's going to be the first $1 trillion company. The stock went up absolutely loads, and it came crashing back down eventually, and it's never surpassed the highest share price. And that's why I'm reluctant to say any stock, or you can just plonk money in, it'll be okay, because if the valuation isn't right, often it won't be okay. So that's why that's why I'm a bit reluctant.
I'll come back to this question of individual stocks in a sec, because Wes has just asked a question that I'll bring up onto the screen. Just to do with obviously with lots of volatility in the market. Basically, what Wes is asking, how are you navigating the current market when everything's going down? I'm sure not everything's going down, but when there is sort of negativity, do you have a plan of action for that?
Yeah, so when everything's going down, it's a big mental game, because when things are going down, you need to be calm and collective. You need to have ice running through your veins. You can't get emotional with this. When things go down, you've got to see it as a good thing that you can buy more at cheaper prices. So, let's say, for example, I've got shares in Facebook Meta. I think a great company. Recently, their shares have gone down quite a bit. And I think I'm down 20, 25% or something now. I'm actually quite happy, because when I've got some more cash, I'm going to be putting more in. Because if I personally think the company is worth X and it's gone down by half, I should be happy, because eventually I think the market will correct itself and it will eventually come back. So
that's your opportunity to buy more. I guess it's a little bit, if we make a direct comparison to property investing. Somebody said to me recently, oh God, we're probably going to be heading for a property market crash at some point. And I said, yeah, potentially. So are you worried about that? I said, are you joking? all my clients are investors. Like, I'm going to be the busiest broker in the world when the stock market, the property market crashes, because all my clients are going to be going out and buying everything, buying up half of UK. Yeah, mate, my bridging finance numbers are going to be through the roof when that happens. But I guess it's a similar scenario when certain stocks that you believe are. And I guess this goes a little bit full circle to what we were saying previously about you need to have that level of knowledge to be able to ascertain, right, where should the value of this be? Okay, it's under now, so I'll buy. And so that means that when actually something you own does go down, it's not necessarily a negative, because you're thinking long term. You actually go, well, this has gone below what I think it's worth. Time to buy up some more.
That's literally it. That is literally it. You already know why you own the stock. You've done your analysis. There's a few key figures you look at / ratios. You know what you value the business at conservatively, and if it's below that by a good amount, happy days. You're happy to go ahead and buy more. And it takes time. Don't get me wrong. It doesn't just happen overnight. With individual stocks, it's taken me a few years to grasp all this. But when it does click, it's a fantastic feeling, because when things go down, I'm actually buzzing. I'm not going to lie, because I see it as an opportunity for me to buy, and I know over the long term it's going to do me well. So I see when things go down, I see it as an opportunity. So yeah, that's the way I look at it.
Go on, I'm going to put you on the spot. If you don't want to answer this question, just say I'm not answering it.
Go for it.
tell me a stock right now that you believe is vastly undervalued.
Ooh, I can give you a collection. So
yeah, I mean, look, the more the merrier.
Yeah, well, I mentioned Meta, Facebook. Currently, Meta is currently trading at, I think it's like 13 or 14 PE. Bearing in mind that the historical market average is about 16, 17. And the thing is with Meta Facebook, it's gone down loads recently, because I think for the first time we haven't grown the amount of daily active users or something. But I don't know if you know this, Sam, but Facebook as a business is absolutely magnificent. Their net margins are 33%. So for every £100, they bring in, £33 is profit, or dollars.
I wouldn't mind that in my business.
You would not mind that, would you? You're talking about a business which has got barely any debt at all. Like, all of its cash could pay its debts and it'd have cash left over. You're talking about a business which has 3 billion people on its platforms across Instagram, Facebook, WhatsApp, and it spends $10 billion a year on the metaverse, which doesn't make any money. It costs them that. So they've got all this money and it's fantastic business, but the market is currently, punishing them. The market, Wall Street doesn't like them. I think the narrative there isn't quite right, personally, from what I personally see. It's a bit like Apple a few years ago. In 2016, Warren Buffett bought Apple. I think for the first time, iPhone users didn't grow or something, and the market got spooked and the stock dropped like 30%. So this happens. It's not just Meta, Facebook. It happens to happens to companies all the time. A narrative comes along, oh, it's the worst thing in the world. It drops. And if it gets to a valuation which is really attractive, that's when it's time to pounce. But yeah, the companies I was going to say, currently China, the biggest stocks in China are currently being punished over the past 18 months or so. So you've got Alibaba, you've got Tencent, you've got Baidu, JD.com.
Where's who gave the last question has put Tencent as well.
Oh,
that
Tencent,
that meant nothing to me. I was like,
so Alibaba is basically the Chinese Amazon.
Yeah.
And then Tencent owns, in China, it's a little bit different to the West. They've got this like app called WeChat. Think about WeChat as WhatsApp, but it does everything. You pay people through it. It's like WhatsApp, but it's more like Instagram. So it's let's just call it a super app. It does every single thing you can think of, and they have a monopoly on different industries as well. Gaming, they own all sorts of different things. But then you've got Baidu, which is basically the Chinese Google, and then you've got JD.com, which is kind of like eBay, Amazon. So you've got like the Chinese big tech equivalents of the US big tech equivalents, and they're currently being punished in their valuations for various different reasons. People are hating China, although 18 months ago, a lot of these stocks were more than double what they were now. And it's all because of the narrative behind them. But if you look at the underlying businesses now, good quality they are, they're making lots of profit, lots of cash flow. There's a bit of a disconnect there, and that's where there's opportunity.
Yeah. I guess and again, that just, I guess, highlights your knowledge. Everything you're just saying there, you might think, well, that's quite basic, but for me, I'm like, shit, like that's such a level, like such a level up in terms of just knowing different regions, and it's because it's a worldwide thing. Back in the day, we'd be looking at British stocks and FTSE 100 or FTSE 250 and all that kind of stuff. Now it's truly international, and to be at the level that you are at, Lewis, you need to actually have an understanding of what's going on in the whole world just to be able to make these kind of decisions, right?
Yeah, 100%. And if you can buy at a low enough valuation, I'll get on to why I think I can beat 7-8%. I think I could get closer to 10-12%. And the main reason I look for individual stocks is because, sure, I could go for an index fund 7-8% over the long term, happy with that. But if I could get closer to 12%, and then you get your compound interest calculator out, that could mean you retire 10-15 years earlier. So that's where I'm at with it. And the main reason I'm into it, I'll come on to how I got into it.
I was literally about to ask you this question. Well. I was like,
yeah.
when you're talking about this stuff, there's a glint in your eye. Like I was going to say, like, what is it about, the world of stocks and the stock market that was your go-to as an investment strategy? I know that you do diversify, but this is your bread and butter, isn't it?
Yeah, it's totally my bread and butter. And like you said, I got that glycerin because I absolutely love it. Absolutely love it. I found something I absolutely love. And when you find that, it's absolutely amazing. It's great.
I'm a bit jealous, mate. It's good to see. It's good to see.
Well, you've got your property finance, haven't you? So
yeah,
mortgage,
I like the finance, just the bloody, the property. that's crap.
But yeah, how did I get into it? So when I was 19, I listened to a podcast. A guy called True Geordie, but he's quite a big YouTuber, a UK YouTuber. He does like football podcasts, whatever. But at the time, he did podcasts with some British bloke. He went to America, worked on Wall Street, made a load of money. Anyway, they were talking, what stocks to have a look at? And they were always saying, oh yeah, cannabis stocks, they're the one. Anyway, it comes to a couple of months later. I managed to make a bit of money off cannabis stocks after listening to this. So me knowing nothing, I just went all in, whatever money I had, it was about £1,000 or something. and I made some decent money. Which was great. And I had to sell because my old car went kaput do you remember the Beast of the East? Beast of the East 2018 time. My car froze over because it was like 17 years old because I didn't put any freezer fluid. A big lesson learned. My car froze over. Oh, I need a car.
It's a good thing you had that money, there, but it must be frustrating because you'd left it there.
Well, the thing is, if I left it there, I wouldn't have had much left, and this is where it gets interesting because it forced my hand to sell. I made 80%, no complaints. But when it happened, I used all the money to buy the car, had no money left, and I was like, all right, okay, I have a little bit of an interest in this. I know I've made some money, but I kind of did know in my own mind that it was luck, pot luck. It's the pun I use, literally pure pot luck. And I knew from there, right, 19, 20-year-old Lewis, right, I've got time on my hands, let's learn. So bought all sorts of books I've got up here, YouTube videos, podcasts. I just tried to dive into it and be like, all right, okay, what's the proper way to do this? You go down the rabbit hole of YouTube and stuff, and I basically come on to Warren Buffett, Charlie Munger, his partner, all different types of investors. And I came on to value investing, basically the process of analysing companies, the financial statements, picking out, the main figures which are important. And then the other side of it is how do you value a business? And then, going from there. And I'm still learning as we go, but I'm getting more confident, more experience and stuff as it goes on. But yeah, that's kind of how I got into it all. But I think, it's easy enough to be like, all right, I'm just doing this on YouTube. But I think one of the main things, basically, no one's here to save you. So if you don't invest in whatever you invest in, so property, stocks, let's just say how old am I? 24. So pension age will probably be 75, 80 when I get that age. And it's currently $9,000 a year pension. Am I going to be happy on $9,000 a year pension?
Well, no. with inflation, it's going to be worth about £9 a year.
Exactly. So it's brutal, but if you don't do something, you're not going to have a great end of life. So you've got to get yourself out there, do a bit more, whether it's earn more and invest more. You've got to do both. But that's why that's one reason I'm interested. It's not, But yeah, you want to think in my head, $9,000 a year. Don't make me too happy. Obviously, if you have a partner and stuff.
It is about kind of there's an element of safeguarding, isn't it? Because this is where I think about kind of my own just wider wealth strategy. I don't really like that terminology because it sounds really grandiose, and I don't mean it in that way. But my ideas of
looking after yourself strategy.
Yeah, building. And because I get to talk to clients all the time, and one of the things I ask them, obviously from the property side of things, is like, what's the end goal here? What are you trying to achieve? It's amazing how many people can't answer that question. I've had 3 client calls today, and I've asked every single one of them that question, and none of them could answer it at all. So you've got to have an understanding, and this comes back to what you just said. If you don't do this, you're staring down the barrel of $9,000 a year income. I could barely do that per quarter. I think I would. I mean, if I actually have that for a month, I think I'd probably find a way of spending that quite easily. So the thought of having that just as a per annum, if that's what's happening, you don't have any other option but to try and find a way of getting yourself out of that. And I do think we actually are heading for a bit of a crisis in the next maybe 20 to 30 years, because that's when we're going to start hitting into the upper ends of our sort of generation that haven't had companies that have invested in pensions for them, private pensions. People don't invest in their own private pensions. I mean, if you literally just want an investment strategy that's the most basic in the world, that will just safeguard you to make sure that you're not going to be be in poverty when you reach 75, is fill out your ISA, even just a standard ISA, and create a pension pot for yourself. Put £50, even if £50 a month, into a pension pot every single month. Just do those 2 things, and that will probably just keep you to a point where you can survive at the very least. Because the alternative is £9,000 a year. You're going to get that £9,000 anyway. Well, maybe by the time we get to,
you just see it as a bonus. Just don't expect it.
Exactly.
So, yeah.
Exactly. But for me, you've got to have all these like diversified opportunities and things. I think of growing various businesses, buying various businesses, investing those profits into all manner of things. And the reason why, I've loved this conversation so far is we've talked about some of the stuff that is volatile. And Wes has got a really good question, which I'm going to chuck in at you in a second. But also, I love the fact that there is. I don't like saying this because I don't want anyone watching this to take this as financial advice, as you said before. But there's almost a safe element to it. A tried and trusted way of, even if, like I said before, we're not going to the 8, 9, 10s or the 7, 8, 9s, even if we're looking at 5 or 6%, on an average, just sticking some money into something that's going to make you 5% per year. Yeah, it doesn't sound like a lot to start with, but my God, by the time you reach the age that you want to retire, that's going to save you. That's going to actually give you a really nice lifestyle. And personally, I don't understand why more people don't do this and don't utilize those kinds of things, because they are freely available. And as you say, you just would click away by just jumping onto YouTube and just typing in what's an index tracker or which index trackers should I invest in, and you're pretty much good to go. Maybe that's the title of your next video, Lewis.
Yeah, I'll have to jot a few of them down for sure.
So this is a good one. I guess I think I asked this we touched upon this at the beginning, but I didn't really actually ask you outright the question. And this is, what advice would you give to a new market participant, i.e., somebody new to investing, who's looking to invest in the stock market? What's like maybe your top 3 tips for somebody new that wants to start learning and investing in the stock market or various stock markets?
Yeah, so I think tip number 1 to start with is it's not a get-rich-quick scheme. A lot of people, Warren Buffett recently did an interview and he said, people think of stocks as something that's just going to go up when you buy it overnight or in the next week or two. It's a long-term process, and the world don't work like that, unless you win a lottery ticket or something. Yeah, sure, people have bought stock and it's gone to the moon, whatever you want to call it. But let's be realistic, that doesn't happen. It doesn't happen, let's be honest. So it's a long-term process, not a get-rich-quick scheme. It's something which is going to be a long-term process over decades, and if you're consistent with it, you will reap the rewards based on the data we've got in the past, as long as you keep doing it as well. So when the market crashes 50, 60, 70%, that's when you want to be loading up more, if anything, because the lower you buy, it's like in property, the lower you make your money when you buy, don't you? So the lower you buy something, the more you're making. So it's the same as the stock market. The lower you're buying, the better. But yeah, keeping with that anyway. So, but yeah, I'm not going to give advice saying like, oh, you must go into an index fund, etc. But I would say go on YouTube, start researching. There's all sorts of content out there. Be it Instagram as well is quite good for it. Start looking for different bits of content on how just get educated, because yeah, sure, you could go ahead and do it, but if you don't really have a little bit of an inkling, you don't have to be an absolute mega investor expert. Just get a little bit of an education, just ask friends, family if they've done anything. If they say to you, put all your money on Tesla, just don't listen to him. But learn about the world stock market, learn about index funds, and then go ahead and make your own decisions on a platform and go from there. That's what I'd say. Like, yeah.
Is there any? Because I know is it the Intelligent Investor? Is like the kind of the Bible. Was Warren Buffett actually? That's the book he read. It was like his Bible for investing.
Yeah. So
would that be your go-to, or is that a bit complex to start
that
with?
One is a bit complex. The Intelligent Investor. It's a famous book because the person who wrote that was his mentor, essentially, and that's where Warren Buffett gets a lot of his early, investment philosophy. Most of his philosophies come from Ben Graham, the guy who wrote that book. That book's is like known as the Bible of value investing. But in terms of something for index funds, there's this book here called The Little Book of Common Sense Investing by.
I like the fact that it's got little in the title. So that's, for me, that's a winner.
Yeah,
It's not that little. It's not that little.
So, yeah, this book was written by the creator of the Vanguard. So,
right, okay.
Vanguard
Probably knows a few things then.
Yeah, well, he did a lot of work in terms of index funds. He essentially created the world's first index fund, because before that there wasn't such a thing as an index fund. In I think the early 70s it was. But in this book, he essentially outlines why over decades that mutual funds can't beat the market because of the fees, because of taxes, and because of the fees on the funds themselves. So that book in particular is fantastic. So I would say read that one, because the majority of the population, they're not going to be picking individual stocks. They're not, and that's absolutely fine. You don't have to. But read that book, get a little bit of an inkling of why. All right, okay, this makes sense, and then get educated, and then do your research into a platform, etc.
Yeah. Is there any? Is there like a? If there was one book that's like for absolute beginners, that just maybe just as like an intro into just stock market investing itself, would that be the one, or is there something a little bit more simplistic than that?
I'd say.
I love the fact that you're just turning to the show.
Yeah.
Which of my 5 million books should I pick out?
Yeah, so for someone who's like never had an interest in money, investing, etc., Rich Dad Poor Dad, I think it's a classic one. I think it gets you in the mindset of you need to be in a mindset of owning assets and not owning liabilities.
Do you know,
that's one reason.
So there's a new social media app. I don't know. I can't remember if I shared this to our little group earlier on. There's a new social media app called Hi Ho, which is a little bit like Twitter but video form. It's really cool. I really enjoy it. And somebody asked a question on there: What's your most favorite, or what's the book that changed like your life? And I replied to it and said it was Rich Dad Poor Dad, and the reason why Hi Ho, the actual app, picked it up and shared it as a reel and as a TikTok. Wow. And like my video today, and I was like, I woke up and I was like, it's like, Hi Ho, it's tagged you in a video. I was like, oh, what? And I was like, oh my God, they've actually done my video about talking about why Rich Dad Poor Dad was the life-changing book for me. Anyone that wants to know anything about just being a wealthy or understanding wealth, understanding money, I think actually that for me is the book, just the book. Yeah, okay, it's got a story to it, and he's like he goes into detail about what the shop looked like that is Rich Dad worked in or whatever, but it doesn't matter. It all just adds to the story. In fact, the follow-up, I'd read Rich Dad Poor Dad first, but then the cash flow quadrant, the cash flow quadrant, which is the follow-up, actually then takes the concepts. Yeah, that's actually a better book. But you have to read Rich Dad Poor Dad first to get an understanding of it, and then the cash flow quadrant is the one. In fact, you know what? I'm gonna put that down as my next reread. So what I do is every 4 books that I read, one of them's a reread. And Rich Dad Poor Dad I reread probably once a year. I haven't reread that one in about 4 years, so I need to get that one back to the top of my tree in terms of rereading. But I know we're running out of time. I wanted to ask you something really quickly, because I'm going to ask you something about something that I know nothing about, but you and Aaron have been on this for ages, and I don't know what it is. What the hell is AMC stock, and why is it so? It's like what's all the big hoo-ha about it? Because I don't understand at all.
Right. Okay. So AMC. I don't know if you've heard of AMC Cinemas. That's what it basically. AMC is basically the American cinema branch franchise, if you want to whatever you want to call it. I don't know if they own Odeon. Can't remember. We might own Odeon. I'll have to look that up. Odeon's like a UK cinema. But anyway, yeah. why did we do videos on AMC? Essentially, in the summer last year, something happened with AMC stock, which made it go up a lot. It's due to a short squeeze. Basically, what a short squeeze is, without getting too technical, it's basically where you've got loads of hedge funds, billionaires invest in hedge funds, and they were betting on the stock, going to zero essentially. But what happened was a load of people on Reddit, millions of people started buying the stock and pushed it up. What happens with a short when you bet in the stock to go down is you essentially borrow the stock and then sell it, and you want to buy the stock at a lower price, and the difference you keep. But what happened was all the shorts got squeezed, which basically meant they had to buy the stock back. So essentially, in a short period of time, the stock just went up like that because there was just millions and millions of people buying it, and the big hedge funds were forced to buy it, and that's why it went up a lot. Nothing to do with the fundamentals of the business. It was all to do with because of this unique event, which it rarely happens. And we did videos on it because it got searched a lot on YouTube, let's be totally honest. Aaron's done well from his AMC stuff, and I've done all right as well. I'm not too bad. Got quite a lot of watch hours. I'll take it. But that's basically what that was. And we've just done videos trying to just give our thoughts and opinions on it, that it's not going to last. And people thinking they're going to, retire after investing into AMC or putting all the money into it, they're going to be very sad once it comes crashing back down, which it has done, because it always was going to. Yeah.
So it literally was a case of, for whatever reason, some people got wind that a load of large hedge funds, etc., were predicting that this stock was going to go to zero, and decided to just bet against them.
Literally millions and millions of people on these Reddit forums, Wall Street bets.
Why did they so want to go against that? Was it? Well, surely it wasn't a love of cinema, no?
Well, AMC as a business itself is pretty much dying. I don't think it'll be around for much longer personally, but because that's why the hedge funds were shorting it, because they made money when the stock price goes down / to zero. So that's they were like, oh yeah, the business is going to die, the stock price will go down. But all these people were saying, screw the hedge funds, screw the Wall Street people, let's go against them, and that's basically what happened with that.
Yeah, this is the masses hating on the.
It's so interesting. Don't get me wrong. Yeah. It's so interesting. But as a way in investment strategy, you might as well just put your money on a horse or an accumulator, because
I love that. Yeah, do you know what? You might as well just. I mean, I know nothing about horse racing. Just chuck your money on a horse. You've probably just got just as much chance of winning on that. Love it. Absolutely brilliant. But look, mate, we've reached our hour, and I know that you're a busy man. You've got, by the sounds of things, you've got a crap ton of reading to do, because you're reading every single company in the world's, financial statements. But look, mate, this was. I mean, I personally learned loads. Hopefully, everyone that has been watching during the live session has enjoyed it. Anyone that's listening back or watching back, hope you've enjoyed it too. If you've got any comments or any questions, what I will do is I'll probably tag Lewis in a comment as well, just to say any questions after this, and you can tag Lewis in it or comment underneath, and you'll be able to, and Lewis, hopefully you'll be able to come on and maybe share some more insight. This will be also be going live on my my podcast, the Game of Loans podcast, next week. So if you're listening along and you want to get in touch with Lewis, you won't see that flashing on the screen at the moment. It says follow him on Instagram at Lewis Hardy Invests. But apart from that, Lewis, any other methods that you want people to go and follow you or reach out to you on?
Yeah, so like you said, my Instagram, my website is lewishardinginvest.com. I've actually just added a coaching page on there now. So if people get a feel for looking at individual stocks, if it's something they're interested in, you can book a bit of time with me, and I'll help you analyze financial statements, how I do it, and how to value a company. And then, my YouTube channel, so Lewis Harding Invest on YouTube. Head over there for all my different content. That's the main place I am nowadays. I love making content on YouTube, to be fair. It's probably my favorite one. So, if you want to message me, just go on Instagram, send me a voice note. I do prefer voice note, to be fair, nowadays.
Me too. Although I can never, sometimes when I'm in conversations, I can't remember what I said. And then they answer it, and I'm like, what did I say? But yeah, no, I get what you're saying. No, cool. Look, definitely, guys, if you're listening, take Lewis up on that opportunity to get in touch and book a call in with him. I can't imagine you're gonna have your money wasted. It's gonna be very, very helpful. But mate, look, I'm genuinely happy that you come on board. Obviously, what people don't realise is you and I have a little bet on as well in terms of monetizing our YouTube channel. So this is actually helping me. So, what an idiot.
I'm such an idiot.
But mate, honestly, I've found this fascinating. So all I can say is thanks ever so much for coming on. Enjoy hopefully a sunny Yorkshire weekend.
Yeah, thank you, Sam. Much appreciated. Thank you.
Cheers, buddy.